All right, good afternoon, everyone. And on behalf of ICO Capital Credit and Finance, I warmly welcome you to today's webinar titled Borrow Smart, Grow Fast, the New Rules of Lending. My name is Michael Otesanya, and I will be moderating today's session. As we know, lending has evolved significantly. What worked 5 to 10 years ago no longer defines the borrowing landscape today. All right, today's borrowers are more informed. Leaders are more data driven, and risk management has become more dynamic, right? And the real question is no longer can I borrow, but rather how do I borrow strategically to drive sustainable growth, right? So, and today's discussion will be exploring the changing dynamics in lending, what smart borrowing truly means in today's market, how business and individuals can leverage debt responsibly to accelerate growth. And of course, today we have an array of distinguished panelists that will be dissecting some of these questions that will be thrown to them. All right, so today, in no particular order, we have Abdullahi Olisa, who is a lead sales manager here at ICO Capital Credit and Finance. We have Michael Adetutu, who is the CRO and the CEO of MyRentLease.co. And we have Indubisi Wisdom, who is the CEO of Zadara Credit Limited. And we want to say a big thank you to you all for joining us. However, to our dear listeners, in the course of our conversation this afternoon, if you have any question, please just drop them in the chat box, and once it's time for the Q&A, we will surely be doing justice to your questions. All right, now, so without much ado, we'll dive right into today's conversation. All right, so Wisdom, I'll be starting with you. What does borrowing smart truly mean for individuals and SMEs operating in Nigeria today? Hello, Wisdom, can you hear me?
Yeah, I can hear you.
Yes.
Michael.
So I said, what does borrowing smart truly mean for individuals and SMEs operating in Nigeria today?
Okay, thank you, Michael, and thank you, distinguished listeners. Borrowing smart for SMEs and for individuals. First and foremost, it's imperative to state that every borrower must ensure that there is a repayment and a growth strategy. And the strategy, the risk tolerance in terms of the individual or the SME that this facility is meant for. But there are key things to look at for SMEs. Number one, for SMEs, for we to say SMEs are borrowing smart, we have to look at the SMEs have to borrow with purpose. And borrowing with purpose implies borrowing only for investments that generates proper returns. This could be borrowing for new machineries, borrowing for technology upgrades, and borrowing for expansion. Two, it's also imperative to understand that you have to choose the right loan type, because we have instances where short-term loans are used for long-term investment. So it's necessary to align short-term loans to working capital and long-term loans for expansions. Then it's also necessary for SMEs to also avoid the debt trap. They should stay clear of loans that had hidden charges. Then it's also necessary to also look at the cost and the benefit of the loan. So ensure that the loan cost, which has to do with the interest and the fee, is outweighed by the revenue that loan will serve for the SMEs. Then if we want to look at for individuals, so it's necessary for us to look at four things. One, you have to borrow for the purpose of either for education, for home purchase, for business, maybe startup. Maybe you want to start up a business for individuals. Then you don't just have to borrow for Owambe. You want to borrow because you just want to get a loan, and then maybe probably be liquid and the likes. That with the borrowing. So it's also necessary that the individual also have what we call repayment discipline. You have to ensure that you budget timely for your repayment. ensuring you avoid borrowing beyond your means. Ensure that whatever you borrow as an individual, it's something that you should be able to pay. It's also key for you to also look at loan comparison. Before you embark on borrowing the loan as an individual, it's necessary for you to compare the interest rate, evaluate the repayment terms, look at the penalties that are involved in this facility. This is something that you can carry, something that your risk appetite can be able to accommodate. Then the last thing for individual, it's also necessary to know that for you to borrow smart, you should be able to maintain a proper credit score. Maintain a proper credit score means that when you borrow and repay timely, the implication is that it gives you options for future borrowing. I think if you're able to put in these parameters in place, you can say as a individual or as a business owner, we can say you borrow smart. Thank you, and I yield the mic.
Michael, can you hear me? I said, in today's Nigerian economy, when does taking a loan make financial sense, and when does it become a burden?
All right, thank you very much, Michael. So basically, I would like to just explain a few notions about loan. One of the few notions is that, one, loans are not bad. So people have the mindset that loans are bad. And secondly, loans are not income, rather a liability to be precise. Then loans are not free money. Loans are not inherently evil. Some religious cleric would say that. And loans are not to cure poor financial, management. So speaking to the question, in today's Nigerian economy, taking a loan makes financial sense when you use it for productive income generating purposes and when repayment are strategically or aligned with your cash flow. So it makes sense when a borrower has a stable and predictable income. It makes sense when the loan tenor matches the business cycle. And this relatively speak to products that are seasonal in nature. And I will use agriculture, for example. Lending to an agricultural sector, your repayment should be tapped to the seasonal product the agriculture person or the agriculture business would be doing. And same thing applies for schools as well. Then moving on, it makes financial sense. It makes sense when the facility is priced appropriately. If the facility is not priced appropriately relative to risks, then it becomes a burden. And lastly, there has to be a clear repayment plan for it to make a financial sense. But speaking to the negative part of it, while it remains a burden, is you find out that a few borrowers used the loans for consumptions rather than production. And when another burden is when the cash flow is unstable, particularly possibly in a high inflation environment. Sometimes borrowers, it becomes a burden when sometimes a borrower underestimates the interest rate and the fees attached to it, and which I believe we'll speak more on that much later. And lastly, when there is when a borrower receives a short-term loan for a long-term need. But in summary, borrowing requires discipline and financial literacy and strong planning. Ultimately, debt should be a tool for growth and not survival. Thank you. Michael, you're muted.
A take home for me, borrowing requires wisdom, and don't borrow for consumption, but for production. So should Abdullah, if I may ask, should you prioritize speed of approval over favorable terms when choosing a loan facility?
Okay, thank you very much, Michael. Also to build up on what the other speakers have highlighted. Okay, so for me to be able to answer this, there are perspectives to this. One of it is we have to look at it from the angle of what situation actually is playing out. Why is the client coming to say, I need this facility? What are the purposes that have been optimized, you understand, for this facility that the client is coming to request for? Now, I will give you instances. For a borrower that is actually requesting for facility tailored towards medical emergency, for instance, I have a project that I want to execute that is actually time bound. Take for instance, I have like a clearing that I need to action within a very short time frame. You can also look at it from the aspect of people that want to maybe buy distressed sales of property for them to be able to also sell off again and make their margin. Now, we have people also, like all these merchants that we have in the market, that want to leverage on the fact that there's a drop in the exchange rate, you understand, to make payment to their suppliers and, make more margin. For those kind of categories of lenders, or I mean borrowers, definitely speed of approval will be more tailored towards it. There will be more tilting towards the speed of approval than somebody that wants to get a fund, for instance, and invest that fund into his business as working capital. Someone that needs that fund for maybe like LPO financing, someone that needs that fund for other projects that is tied to income generation, so to say. Those kind of people would definitely want to go by, the terms of the condition, how favorable it is, what is the interest rate, what is the fee that also attached to that kind of facility. I get better repayment period that I can get based on the project I'm trying to execute. So for those categories of borrower, they will be more tilted towards getting the favorable terms than probably the speed of approval. So it's a two-leg approaches, and I think it depends on what you want to do basically in summary, and it depends on the purpose you need that fund for. Thank you very much.
All right, thank you so much, Abdullahi, for that. All right, so Wisdom, well, what should you look out for in loan agreements beyond the advertised interest rate?
Yeah, thank you once again, Mike. I think beyond the highest interest rate, there are 4 key things that I think is necessary to look into beyond the advertised interest rate. I think number 1, you look at the fees and charges. What are the fees embedded in this facility? For instance, there are some facilities that comes with processing fees. Some comes with the insurance fees or legal fees and penalty for late repayment. Then 2, also look at the repayment flexibility. How flexible is this repayment? Is there a grace period? If I default, do I also have options of loan restructuring? Can I make a balloon payment? If there's a delay in terms of, let's say it's a payday loan, or let's say it's an LPO financing, and you're supposed to, your vendor is supposed to pay you maybe in 30 days, and it doesn't come in 30 days, your loan guarantee grace period. If you pay your salary comes every 30 days, and suddenly you get an announcement from the that payment will be coming in after what is the implication for this facility? So, what have you used to collateralize this facility? If you're able to meet up the repayment, do you lose this facility? Maybe you lose maybe a fixed movable set. The loan agreement states that if you default, you are going to lose most of these assets. Then another thing too is look at the covenant. There's some loan facility that you take that has certain restrictions, which limits you from accessing additional loans. So it's clearly stated there that if you access this facility, you are limited from accessing other loan facilities. So a situation where customers come, look at the interest sign without looking into the details of the loan and seeing if this loan actually comes a covenant that restricts me from accessing further facilities, so it's necessary. Then another key thing too is you look at currency and inflation risk. Today the world is global and people access facility not only in local currency but also access in local currency, in foreign currency. So you also ask yourself, if the loan is paid to USD, what is the impact of the local currency volatility? What is the impact if it depreciates? Do you have the strength, the capacity to be able to repay those facilities in foreign currency? So it's key to look at the fees and charges, the repayment flexibilities, the collateral requirement, covenants. Then you also look at currency and the inflation risk. Thank you, and I yield the mic.
Thank you, Wisdom. Thank you. All right. So, Michael, with interest rates fluctuating, right? How can Nigerian borrowers determine the true cost of a loan?
All right. So borrowers most times should look beyond the advertised interest rates and to determine the true cost of a loan. Most importantly, this is called EIR, effective interest rate, and because the advertised interest rates is not what forms your repayment, but also part of what forms your repayment, because there are other fees. And there are fees like processing costs, there are fees like administrative fees, legal fees, depending on the organization, management fees. However, borrowers can determine the true cost of a loan by first, they should request for their APR, which we call the annual percentage rate, because this captures the interest rate. It also captures other fees as well. Then secondly, borrowers should also go back to their loan covenants or their offer letter or their terms of agreement to check if it's a fixed or a floating interest, because there are times whereby in the Nigerian context, let me put it as an example, influenced by the Central Bank of Nigeria, the monetary policy decisions, you will find that some institutions make use of floating interest rate, whereby once there's an MPC, then they tend to review their interest rate, which an email or a communication will be sent to such individual borrower. Then thirdly, a borrower should ask for a full repayment schedule or the amortization schedule. While doing that, he or she should also calculate the total repayment of the loan cycle or the loan that he or she has taken. Also, he or she should compare cost. I always tell borrowers to always compare the total cost of a loan with other competitors so as to get a better and a competitive rate. And then lastly, consider inflation. And this is where MPC always comes in. Consider inflation, because most times, your rate can be reviewed. But in summary, a true cost of a loan is the total amount repaid over time and not the advertised interest rate. Thank you.
All right, thank you so much, Michael. All right, so just to remind our dear listeners that if you have any question, please just drop them in the chat box, and once it's time for Q&A, we'll respond to them accordingly. All right, Abdullahi, how can borrowers negotiate better loan terms that won't put a strain on their financials?
All right. Thank you, Michael, for that. The other panelists have actually touched on some of the points. Number one thing I used to emphasize with anybody that I'm trading with, especially that wants to access any facility, that is also willing to listen, come from the place of knowing. What do I mean? If you don't know what is obtainable in the market, there is high tendency that you are going to, get yourself hit at the back of the leg. We have cases where, because of ignorance, too many people have subscribed to contra that, at the end of the day, they tend to struggle to repay. They tend to struggle to repay. So what you need to do as a borrower is number one thing is research what is actually obtainable in the market. Do some market analysis of what the other competitors are giving in pricing. Number one, so that you don't get yourself locked up with the loan shark. Also, you must understand your credit history, because number one thing is if you don't really know how you have done or how you perform, you don't really have the power to even influence most of those decisions. So by so doing, I mean you need to be able to make case for yourself based on the previous loan you have taken. How much have you done? If you are not like a bad borrower, so to say, that also gives you some mileage to getting a better bargaining anytime you are getting a new facility. All right. Another thing you need to also work on to be able to get a better terms when you are requesting for loan facility is present a financial stability, show that your business is stable. Your cash flow over a short period of time or over a long period of time, depending. Do you understand how have you been doing? How stable is your business? If you're able to put that forward before any lender, it gives them some level of confidence to be able to trade with you. And we all know that most lenders operate a risk based kind of pricing nowadays, which means if, for example, you are also coming to request a facility and the facility is fully secured, you have collateral cover for this kind of facility, and there is 100% guarantee that in case anything goes bad, there's also something that the company can fall back on. That alone can also give you some level of mileage in terms of negotiating a better terms. So those are a few things that you can work on. Getting a collateral cover for any facilities that you are going for, that is at least what the value you are requesting for. Building up a very good credit score, so that at least people that you want to take these facilities from, they have something to reference to that you have done this, and you have performed. Then also do a market research of what is obtainable from other lenders so that you don't get yourself stuck. Thank you.
All right, thank you so much, Abdullahi, for that. All right, so Michael, how can SMEs in Nigeria use loans to survive cash flow gaps without falling into a debt cycle?
Okay, so for Nigeria SMEs, loans should be used as a bridge and not a permanent solution, right? And so first thing to do is to identify the root cause and the root cause of the gap. And you are basically looking at maybe you have a delayed receivables, you have seasonality in terms of the type of product you do offer, maybe inventory build-up or poor expense management. And this is one of the major things that affect many fintech startups at the moment. However, borrowing without having a fix, without having an underlying issue often leads to repeated borrowing. You don't have an underlying issue, you keep borrowing, you just keep borrowing because there'll be no full utilization of that fund. So secondly, one thing that again that I'm going to say is they should match the type and tenure of the loan with their cash cycle. As I repeated, I said this for in the previous question asked, that your cash flow cycle should align with your repayment plan. Because, for example, short-term working capital facilities should be used to finance a short-term need. You find out that some people or borrowers use short-term working capital or short-term loan to finance a long-term project. And this always makes those SMEs fall into a debt cycle. And then thirdly is what I advise borrowers to do, especially before falling into a debt cycle, is borrow what is required, not the maximum offered. In the business of making profit, most institutions will want to offer you the maximum so that they can earn more interest rate. But however, be disciplined as a borrower, only borrow what is required and not the maximum offered. Another thing again is ensure your repayment is tied to your cash flows. You don't want a repayment that's being tied to, let's say your repayment is 31st of every month, and your cash flow, the bulk of your cash comes in 15th of the next month. And this is where payday management system comes in. Then also negotiate the structured repayment terms with your lenders. When you negotiate the structured repayment terms, let's say, for example, you tend to have a bit of laid back cash flows. Always communicate that to your lender so that your lender can, do some assessment analysis on you and your current cash flow and be able to align that so that you have a restructured repayment plan. But most times, what I always tell people is a loan should be a loan, but borrowing shouldn't become a routine, right? It should just be occasional, because if the borrowing becomes a routine, then that is a first warning sign of a debt cycle. Thank you.
All right. So, Michael, in addendum to that, based on what you said, to what extent can one or people negotiate a structured repayment plan? Because of course those things will have been stated in the terms of agreement, right? So a lot of persons will have feel, oh, this is the way they want it done. So to what extent can one go ahead to negotiate a structured repayment plan?
Okay, so one of the major things that leads to a restructured repayment plan is when there is a change in your cash flow cycle, or when there is a change in your business income or your business products. And with that, I'm going to paint a scenario to answer that question fully. Let's say Mr. A decides to get a loan from you guys, to get a loan from BX company. And at the point of getting that loan, assessment were done and everything was done, and the cash flow shows that the income, there is high income coming in at the end of the month, every last day of the month. But in this, it gets to a point whereby Mr. A decides to say, I cannot, you as a business, you get to see that, BX gets to see that when it comes to that last day of the month, Mr. A doesn't repay, or Mr. A gives some sort of an excuse to say, no, I'm expecting inflow at the particular date. Then it is not left for the business to see the default patterns, see how the inflows have been coming in, see the days past due, and see if there is going to be some sort of an alignment in everything. And once they see that, then the business can propose and say, you know what, we've noticed that your repayments, when you pay, you always pay at a certain period of time, the range, so the business can propose a repayment structure. However, for the side of the customer or the borrower can also speak to the lender and say, let me use salaried employed, for example. Hi, my salary has been changed. My salary date has been changed, right? I know my salary used to be 31st of this month, but however, it has been changed to the 5th of the next month. And from your offer letter, the grace period says 2 days, which means the third day I'll be in default, which means penalty will be coming in. So that person or that borrower then should now reach out to the lender with these details, and the lender would verify those details and, verify those details and propose a restructuring or restructure repayment plan for such individuals. And this applies to not just individuals, as well as corporate entities as well. Thank you.
All right. Thank you, Michael. Thank you. All right. So, Wisdom, how can you determine whether a loan will accelerate growth or strain your operations?
Thank you, Michael. I think one key thing that is imperative is to assess the purpose and the expected return for that facility you're taking. And this leads us to three things. One, you ask yourself this question, is it growth oriented? The purpose why you are assessing this facility, is it for growth? Is it loan? Is it funding revenue, generating investment? For instance, are you using it for equipment? Are you using it for marketing purpose? Are you using it for business expansion? So if you look at it that, well, it's for growth, then you know that it will accelerate growth. But if it's not for growth, then you should just know that it will strain operation. Two, you do what we call the cost versus the benefit analysis. So what you do is I estimate how much additional revenue will this loan create if we should assess this facility. Is the cost outweighing the benefit, or is the benefit outweighing the cost? So when you do the analysis and you discover that the benefit is outweighing the cost, then it's necessary to know that it will accelerate growth. But if the cost is outweighing the benefit, then you should know that it will strain your operation, and there's nothing you can do about it. So you're already in for the trap. You're already in the trap, and you're already in for it. You're already in for default. You should know that probably you may be heading to insolvent. Then the third thing, you should look at your return on investment analysis. You compare your expected return from the loan use. Now, the interest plus the fee. When the interest and the fee that you will be paying on this loan will outweigh the return on investment, or will the return on investment outweigh the interest and fees? If the return on investment will outweigh the interest and fee, then you should know that it will accelerate growth. But if the interest and the fee will outweigh the return on investment, then you should know that you're already in for the hammer. You should understand that definitely it will strain your operation. And that is why in business, when you're assessing a facility, it's always necessary to understand the cost of the loan. That if the cost of the loan outweighs your return on investment, then there's a risk on that facility. It will strain operation. But if the return on investment outweighs the cost of the loan, then you should understand that there'll be likelihood for growth. You're heading for growth. So it's necessary to weigh the cost versus the benefit, then look at, is it growth oriented? Also look at the return on investment analysis. Does the cost outweigh the benefit, or does the benefit outweigh the cost, or does the interest and the principal outweighs the return on investment, or the return on investment outweighs the interest and principal? Thank you, and I yield the mic.
All right. So, Abdullah, what signals indicate your business is ready for a bigger loan?
Okay, Michael, thank you very much for that question. One thing is that we need to understand that you must show capacity before you can even think of increasing the limits you are being available to, generally from any lender. But internally, how do you know that as a borrower, your business actually needs higher limits, which is what we are discussing here? All right. We've had cases where people not necessarily need as high as what they requested for. You know, the money is being injected into their system, and at the end of the day, you know, they find it very hard, you know, fulfilling the obligation of repayment. All right. So there are some fundamental questions that you need to ask as a business that want to upscale, in my word. All right. How have you been doing? How are you doing currently? Has there been consistent growth in your business? If your business is not growing, there's no point increasing your exposure. There's no point injecting more money into it. Like a building that is already collapsing and you're still pumping money into it. That might not really change anything. So I would say, as a borrower, you look at your revenue first. Be very sure that your revenue has been on a very good trajectory over the last, let's say, 5 years. All right. Look at your cash flow. How much have you been doing? Last 2 years, I was doing this cash flow, but today the business is bringing up this kind of cash flow. Those are the little signs that you need to check, or things that first indicate that your business is growing. How operational stability do you have in your business? We have seen cases where people are doing like this today, tomorrow again they are doing other things. Your operation is like this today, next month the operation is something else. You need to have that stability in terms of your process flow, in terms of the system that has been designed already to carry the operation. Because if the system is also faulty, there's high tendency that um, the business is going to struggle. No matter amount of money you inject into that business, you will struggle. And why do you need to put in pressure on yourself when you can stabilize the system first before you mobilize your fund? Strong management system is also very key. You must also have at the back of your mind before you can even think of injecting more fund into your business. Do I have like an expansion plan? Do you understand? This money that I'm bringing into the business, what do I need it for? Is it for me to be able to expand the business to a new location? Maybe I'm launching new products, maybe upgrading some of the existing equipment I'm using. Are we breaking into new markets that we need to open a new branch? Do you understand? There must be a specific purpose for whatever money you're calling for or trying to bring into your business. So in summary, I would say before you decide to increasing your exposure, ask those fundamental questions first and be very sure that your business is growing. There's no point adding more fund into your business if the business is struggling. And I'll rest my case for now. Thank you.
Thank you, Abdullahi, for that insight. Yeah, to our listeners, you've heard it all. Ensure you are asking questions, and this is to also remind us to for your questions. We'll soon be getting to the Q&A session, and then we'll be taking your question. All right, Wisdom, I have a last question for you. Right, is it smarter to scale gradually with retained profit or aggressively with loan average?
Oh, thank you once again, Mike. Well, I think both decisions are key. Both decisions are important. It all boils down to your strategic business direction. If your strategic business direction as a business person is to grow slowly, if your strategic business direction is for you to maintain some high level of discipline, if your strategic business direction is to, okay, I just want to carve a niche, I just want to study the market, then it's necessary to grow with retained profit. But if your business strategy, you want to be a challenger, you want to be the leader in the market, you want to launch and compete with other competitors. I can remember when there was a telecom company that came into the Nigerian space a few years ago, because they understood that the sector was promising. That was when during the introduction of the mobile phone mobile phone to Nigeria. They had the business idea, they studied the market, they understood that the market is very promising, but they were short of funds. What did they do? They approached the commercial bank. The commercial bank gave them as at then around 50 million, and the repayment tenure was around 10 years thereabout. But within a space of 2-3 years, they paid off the loan because they saw that the market was promising. They saw that there was potential for growth, and the only way to capture the market as at then was to leverage through loans. Then they went for it. So their strategic business direction enabled them to go for loan, for them to gain the traction in the market. However, if you've not done your research properly, you've not studied the market, then another thing too you should also look at, do you also want to also attract more investors? Because one of the fears that makes most business people not to go for facilities is the fear of, oh, if I go for loans, probably there must be some agreement that XYZ percentage of the company, maybe the shares of the company and be gains on shares of the company and not the likes and that. So it's okay, let me just work on return profit. But however, in a promising economy, in a promising business environment, if your research is well done, you have a larger size of the market, going for loan facility to scale is the best option. And like I said earlier, if you want to just carve a niche in the market, not just ask too much question, maybe you want to be like a spectator in the market, just watching what happens, then you can work on return profit. But over time, those that have made impacts in the market, those that have captured the market, most times they go on the leverage on loan facilities in expanding, especially when the market is promising. But that's another thing. Excuse me. There's another important thing. It's also necessary to also blend both. Don't also expose yourself much. You can work on a little bit of return profit. Then you can also leverage on loan. Then if you're able to also capture the market gradually, then it will give you that advantage because your exposure will be reduced. Your exposure will not be too high. Thank you, and I yield the mic.
All right, thank you, Wisdom, for that. All right, so to our listeners, this is just to let us know again. We'll be getting into the Q&A session very soon. So just drop your questions in the chat box, and we'll pick it up once it's time. All right, so Michael, a last one for you. Can strategic borrowing help Nigerian businesses compete in a tough economic climate?
Okay, can you come again with the question?
Okay, so I was saying that can strategic borrowing help Nigerian businesses to compete in a tough economic climate?
Oh yeah. Yes, strategic borrowing can absolutely help Nigeria businesses compete, but only when it is intentional and growth focused, right? In a tough economic climate marked by macroeconomic variables in Nigeria, access to capital can invest in areas that can improve efficiency and profitability. For example, borrowing to upgrade, let me use the fintech as an example. Borrowing to upgrade your equipment or your IT aspect, digitize operations, expand your sales can create a competitive advantage. And once you create a competitive advantage, then the borrowing becomes a strategic borrowing. So strategic borrowing can allow business to, scale faster when the need arise, and rather than relying solely on retained earnings. Just like one of the panelists has mentioned, wisdom in the retained earnings aspect. Secondly, strategic borrowing can allow business to, take advantage of market gaps when competitors are constrained. And I'll give an example one that happened during the COVID era. That was when most institutions were trying not to, lend to companies or lend to individuals. But the company I was as of then, had to borrow more funds to lend to people or to lend to other borrowers. Excuse me. And with that, the profit rose because competitors were not willing to lend us at that time. All right, so strategic borrowing can also improve productivity as well, and thereby reducing operating costs. Excuse me, apologies. However, the key thing we should put in mind is your ROI, which is a return on investment, must always exceed your cost of borrowing. And when that is being done, then you know that you are, doing the right thing and not using that strategic borrowing to fund recurring losses. So in summary, what I can say is access to capital is not just about survival. It can be a competitive tool. Like I mentioned earlier, loans are not inherently evil, But if it must be calculated, it must be disciplined, and it must be tied to a very, very measurable growth outcomes. Thank you.
All right, thank you so much. Thank you, Michael. Thank you. All right, so we now open the floor for questions from our listeners. And of course, you feel free to drop your questions in the chat box and I will address them as time permits us. So if you have any question, please feel free. The floor is open for us. Does anyone have any question to ask our panelists? All right, so I would want to take that as we don't have any question to ask our panelists. So I would say on that note, we want to draw the curtains on the webinar today. All right, and we want to appreciate our panelists. Can we just appreciate our panelists for the wonderful insights they have shared with us today on how to borrow smartly. All right, so as we conclude today's session, one key takeaway stands out, right? That borrowing is not inherently risky. You being uninformed about borrowing is what is risky. And of course, in today's lending environment, smart borrowing requires discipline, strategy, and alignment with long-term growth objectives, right? And on behalf of ICO Capital Credit and Finance, I would like to sincerely thank our panelists from Abdullahi to Wisdom to Michael for sharing their expertise and practical insight. And to our wonderful listeners and audience, we want to say a big thank you for investing your time with us today. And remember that the goal is not just to access capital, but access capital that works for you. And thank you, everyone. And we look forward to engaging with you again at our next webinar. Thank you so much, everyone. And we say do enjoy the rest of your day.
All right, thank you, everyone. Thank you, Michael.
Thank you.